Good afternoon, everyone. Costa Rout from Westpac Corporate Partners. Got Tim Lawless with me. We'll just give everyone another 2 moments there just to log in. We're seeing the numbers steadily climb, so we'll just give everyone another 90 seconds, 120 seconds. Bear with us. Thank you. Okay, as we just tick over towards 12:32, I think we'll move forward for everyone. Good afternoon, everyone. My name is Costa Rout. I'm a corporate partner manager here at Westpac in Victoria. Welcome to our national webinar, Property Market Reflections, What's Happened, What Will Happen, presented by our good friends CoreLogic. We're excited to have our guest speaker, Tim Lawless, the Executive Research Director of CoreLogic's Asia Pacific division. Tim manages a team of economic and data specialists across Australia and New Zealand. He brings with him more than 20 years' experience to the role, providing deep insights and analysis on national housing trends. We do hope you get some key takeaways from today, and if you have any questions during the session, there's a chat bar. So please enter your questions as they arise. We'll try to answer as many as possible at the conclusion of our session, and you can always email me directly. So over to you, Tim.
Costa, many thanks, and it's always a pleasure to be here with our friends and partners at Westpac. I hope anyone who's in any flood-affected areas is doing okay. It's awful to see some of the footage. As a Queenslander and been through a few floods myself, I know what it's like. So hope any of those people in flood-affected areas are getting through it okay. So what I wanted to focus on today, we've got a full hour. I don't intend to take up that full hour because, as Costa mentioned, there's definitely time for some Q&A and some discussion as well. So I wanted to focus on, obviously, the trends in housing values, but beyond that, I'll also cover what we're seeing in terms of activity, listings, number of sales, finance-related activity, rental markets, very topical at the moment. They're doing the opposite of housing values and rising very quickly. Some of the construction trends, and then, as Costa said, a bit of a where to from here, although just qualifying that it's trying to get an understanding of the property market forecasts is hard at the best of times, let alone at the moment. But I certainly encourage you to look at some of your own economic team's research, particularly what Matthew Hassan is putting out. His latest housing market forecast and so forth just came out, which was certainly a very good read. So let's start in focusing on the trend in values. So starting fairly macro, this is a national graph, and it looks at the month-on-month change in housing values through the pandemic and then prior to that, but probably more importantly, what's happening over the past 5 or 6 months since interest rates started to rise. So everybody would know that, of course, we've been through quite the spectacular upswing in housing values. We saw nationally home values rise by nearly 30% through the growth phase over about 20 months. But well and truly, we're now into the downside of that upswing. So values have been falling over the past 6 months. But the interesting trend, I think, is you can see the worst of the decline, at least to date, was in August. And then we saw September as a subtle reduction in the rate of decline, and then October again. So falling from a national rate of decline of around sort of 1.6%. I think by the time we report our November numbers, just looking at what our daily index is doing, we're probably going to be at about a 0.9%, maybe a 1% fall through November. So we're definitely seeing some signs that the the speed of the decline is losing some momentum, although that's not to say it could re-accelerate. Of course, if we see, for example, the RBA reverting back to a 50 basis point hike rather than 25, or we see some sort of a shock, absolutely that could see the rate of decline once again re-accelerate. But it's fair to say this is well and truly evolving into a trend rather than any sort of volatility or a blip in the trends that we're seeing. And you can see that improvement in the rate of decline most specifically in Sydney and Melbourne. So we're just looking at a rolling 4-week trend in housing values here across the 5 largest capitals. So absolutely, Brisbane is now showing the fastest rate of decline, roughly down about 1.9% month on month at the moment. Sydney, back in say late August, was seeing a monthly rate of decline that was about 2.3%. That's now getting back to about 1.1%, and Melbourne is seeing the rate of decline now at about 0.5% down month on month. And you can see, of course, Adelaide and Perth, maybe a better description of that market at the moment is more stabilization rather than a true, say, correction or decline. Housing values in both of those markets have hardly budged since interest rates started to rise. They've been very resilient so far. But of course, the trends more broadly have been very diverse. And what we're looking at here is simply the cumulative trend from the commencement of COVID. So we talk about pre-COVID being before March 2020 generally. And what these graphs are tracking is how much of values changed between March 2020 and the end of October 2022. You can see pretty much everywhere has recorded quite the spectacular capital gain, but again, there's quite a bit of difference. Look at a market like Melbourne, for example, and you can see the trend has been very different. For example, earlier in the COVID decline phase, this is through early 2020, Melbourne recorded a sharper drop. Housing values there were down about 6% through early COVID. And then through the upswing, you can see that it was a much milder increase in housing values. Melbourne values increased by about 17% through the upswing, compared to, say, an Adelaide or a Brisbane, where we saw more than a 40% gain in housing values. The regional markets, of course, very strong. Every major regional market has seen housing values rise by more than 25%, generally more than 40% in markets like Tassie, regional South Australia, and regional New South Wales and Queensland getting close to a 40+% gain as well. But of course, as values fall, we're starting to see some of these COVID gains being reversed. In fact, Melbourne, we'd only need to see Melbourne housing values fall a little bit more than 3% before they get back to March 2020 levels. So it's almost a guarantee that we'll see Melbourne moving through this down phase and finishing at a level that was level with pre-COVID times. Whereas every other market, you need to see a much more material decline from current levels before we saw these very strong COVID gains being wiped out. So a lot of people are focusing on the speed of decline, which is very relevant. We are seeing housing values falling a lot more rapidly than we have through previous downturns, which is what I'm showing you on the graph on the left here, the speed of decline and the length of the decline phase through previous downward periods of corrections. So you can see the current correction, which is this dark black trend line, is down 6.5% over about 6 months. So we haven't seen housing prices fall this rapidly previously, even during the global financial crisis or during previous recessions back in the early 90s, the early 80s. Housing values weren't falling this rapidly, but the context is really important because previously we hadn't seen housing values rise this rapidly either. And that's the graph I've got on the right-hand side, just highlighting that 2020 to 22, about a 20-month period, where we saw about a 26% rise in capital city housing values. That was a very rapid pace of increase as well, very short and sharp. Arguably, this down phase could also be quite short and sharp, but it really depends on where interest rates land. Okay, and I'll talk a bit more about interest rates later on. But again, I direct you to your own economics team, who absolutely are amongst the market leaders for forecasting where interest rates may be going. Westpac's forecast, by the way, is interest rates getting up to about 3.85% of the cash rate, along with ANZ at a fairly similar level. Whereas look at some CBA is at 3.1%. And you've got NAB sort of in the middle there as well. So definitely quite the variety and the broad range of cash rate forecasts. I think that just speaks to the sheer uncertainty about where interest rates are going to get to, and of course the underlying inflation readings as well, where they'll start to get under control, which will give the RBA the impetus to find a ceiling for interest rates. So if we look a little bit more closely at some of the trends, I've got a rolling quarterly change across the capital cities here. And you can see what I was talking about with regards to this subtle improvement in the rate of decline coming through in the most recent couple of months of data. Remember, this is a rolling quarterly change, so it's smoothed out a little bit. If you was to look at say the monthly data, this improvement in the rate of decline, or the easing in the rate of decline, has become quite noticeable in Sydney and Melbourne, particularly across the upper quartiles of those two markets, which is exactly what I'm showing you here. Just breaking the market down by your upper quartile, which is your most expensive quarter of the market. You know, your top 25% of properties based on value has been much more volatile, particularly in Sydney and Melbourne, where you can see that end of the market tends to lead the upswings and also lead the downturns. Very normal for that to happen. That's exactly what we've seen through the most recent couple of cycles, a much stronger growth phase, and now we're seeing that upper quartile leading the downturn, but also more visibly starting to turn in its growth and its downwards trajectory. Same as in Melbourne. Brisbane and Perth, not quite as evident. We don't really see the same sort of extremes in those two markets. Probably because we don't see housing affordability as stretched in those markets, especially Perth, but also they don't have as much diversity in housing stock as what, say, Sydney does or Melbourne does. One way to look at that diversity is to look at the interquartile range. So looking at the difference between the 75th percentile and the 25th percentile, the wider that range is, the larger the amount of diversity there is in housing stock in those markets. So go to somewhere like Darwin or Adelaide, and your interquartile range is very narrow. Go to somewhere like a Sydney or a Melbourne, and it's very wide. Kind of an interesting way to look at the level of diversity or homogeneity in housing stock. We also know that the regional markets have been a lot stronger than the capitals. And you can see that in these trend lines here. I'm just tracking the rolling 3-month change across the combined capitals and the combined regionals. And you can see that, well, previously through the 2012 to this 2017 growth cycle, absolutely it was capital cities leading the growth trends. Regional markets were a bit more resilient through the downturn, which kind of went between mid-2017 and mid-2019. But through this COVID cycle, we have seen a real demographic shift that has favored regional markets. There's more people left the capitals to go to the regional markets, and fewer people came from regions back to the capitals. That's really influenced demand for housing. Although it's fair to say that's starting to change. If you look at ABS demographic data, it's pretty hard to pick up the slowdown in regional migration growth, but there are a few private sector measures that look at trends across regional Australia. And it's very clear that up to the September quarter, well, from March 22 through to the September quarter, it's very clear that the rate of growth has been slowing into regional Australia. Still above what it was pre-COVID, and I feel fairly certain that there's probably been a structural change in the underlying demand profile or population of those commutable regional markets. But absolutely population growth is slowing down to those areas, driving this slowdown in housing markets as well. And it's also fair to say, because of this rapid growth trajectory, the affordability advantage a lot of regional markets have had has been eroded. Not completely, but in some markets like Geelong, for example, the median value is pretty much bang on par with the median value of Melbourne, whereas there's still a pretty decent gap between, say, Newcastle and Sydney and Wollongong in Sydney, though it has diminished quite a bit. The major regional centres, and these 8 markets are certainly representative of what we're seeing in some of the more popular regional markets, is, well, firstly, of course, we did see quite the extraordinary upswing in housing values across many of these areas. Look at the Southern Highlands, for example, this graph top right, and you can see that housing values in that market were up 59% through the upswing. They've now fallen by about, since peaking, they're down about 10%, 7% of that over the most recent 3-month period. You've got the Richmond Tweed up about 50%, the Sunny Coast and the Gold Coast up a little bit more than 50% in those markets as well. But each of these areas is recording a downturn. So don't think these regional markets are going to be insulated. Clearly they're not, but they've got a long way to go before they get back to where prices were pre-COVID. I don't think that will be the case. In fact, far from it. I think these commutable markets will generally be much more popular now that we see a formalization of a lot of the hybrid working policies now becoming somewhat permanent. So that simply means that these markets that have a lifestyle element and are somewhat commutable are probably going to be more popular than they were pre-COVID. So what are we seeing through the downturn? I think there's some really unique characteristics of this downturn that's worth sharing. And the first one is just looking at the level of activity, both in listing numbers and sales activity. So I've got a couple of graphs on listings on the left and in the middle, and then sales activity across the combined capitals on the right. So there's a couple of things that I want to talk about here. The first one is that overall advertised supply levels have been really low through the pandemic to date. Initially, through the early phases of the pandemic, this was more about a really rapid rate of absorption. There was more than normal new listings flowing into the market, but demand, the number of home sales was around record highs going through 2021. So those homes that were being added to the market were being snapped up really quickly. Days on market was tracking about 19 days at the end of last year, a record low, which has really kept overall supply levels or advertised inventory levels around record lows, albeit with some seasonality. More recently, though, you can see sales activity has slowed quite sharply. You'd naturally think that that would result in an upswing or a lift in the amount of homes that are available for sale, but you can see that that's not the case. Looking at the graph on the left here, overall stock levels still remain very low. This graph's up to about the middle of November, by the way. So we are still seeing listings holding very low. This time around, though, through the downturn, it's more about a very mild flow of new listings coming onto the market rather than a rapid rate of absorption. So you can see this new listings trend here, the graph in the middle. We're seeing new listings tracking about 30% lower than this time last year and about 17% below the 5-year average. So there's a couple of things you can take from that. The first one is that, say, homeowners that are thinking about selling are mostly holding off. If you don't need to sell your property at the moment, you're probably going to wait until selling conditions improve a little bit. Also, there's no real sign of, say, distress or panic selling or dumping of stock on the market or anything like that. So the seasonal uplift for spring has been very delayed, and it's also been very muted compared to previous years. New listings tracking about 17% below the 5-year average. But that is happening against this backdrop of falling demand. This is the graph on the right. So we've seen demand fall from nearly record highs at the end of 2021, more than 600,000 sales over a year, down to about average levels. And that's probably the most important aspect of this downturn so far, is that we haven't seen the bottom fall out of housing demand. It's fallen back to about the 5-year average so far. My guess is it'll fall further from here. So absolutely, there is still some downside risk. The reason I think activity will fall further is simply because interest rates will be rising further and borrowing capacity will be reduced further. But one of the key factors to watch is going to be consumer sentiment. If we do see sentiment starting to rebound, potentially that could be the case on the back of very strong labour force figures for October. The fact that the RBA's moved back to a bit more of a dovish note and are only rising by 25 basis points a month now. And particularly if we see the cash rate starting to find a ceiling as well, then maybe we might start seeing sentiment starting to rebound off its almost recessionary lows at the moment. And again, I'd certainly direct you to the Westpac Melbourne Institute monthly reading on consumer sentiment. I certainly follow that series very closely. Okay, I mentioned a little bit about average selling time and selling conditions being a bit tough. These graphs sum it up. So these are what we call our vendor metrics. You've got a couple of private treaty metrics on the left. That's how long does it take to sell a property, median days on market, and you've got your median vendor discounts. And then on the right, you've got auctions, which excludes any private treaty sales. So a couple of things you can take from this is, well, absolutely it's taking longer to sell a home. At 33 days, that doesn't look exceptionally bad to me. Clearly, it'll rise further from here. Remember, it's a rolling 3-month measure as well, so it's a little bit smoothed out. But look at the discounting rates. So discounting has fallen a lot more sharply than days on market. And what this really says to me is that those people who are selling their homes at the moment are much more willing to be flexible on their pricing expectations to meet the market in order to offload their property, probably because they know the longer they leave the property on the market, the more housing values are going to fall. So they're quite motivated or incentivized to be more negotiable on their asking price. You can kind of see that in the clearance rate as well. Clearance rates have bounced from around 50% back to sort of the late 50, early 60% range. And again, I think that probably reflects more that vendors have become willing to meet the market and meet buyer expectations rather than a true reflection in improving conditions. Although that improvement in the clearance rate has also coincided with the easing in the rate of decline in values as well. I mentioned consumer sentiment. So this is the Westpac Melbourne Institute graph on the left, just tracking the index itself. You can see what I mean by the fact that sentiment is pretty much around getting close to recessionary lows. This is where it was back in the early 1990s, getting down to the high 60% range. Whereas at the moment, we're getting back to the worst of where it was in early COVID, about where it was during the global financial crisis as well. But as you can see in the graph on the right, where I've just correlated the number of home sales with the consumer sentiment index, these two factors or two indices are very highly correlated. Low sentiment obviously means households find it much harder to make a high commitment decision, like buying or selling a home. So unsurprisingly, watch the sentiment figures. If we do see a bit of a turnaround, then potentially that could be the signal that we could see more mortgage activity, more home buying activity coming back into the market. We can also look at the different sectors of the marketplace that have become either less active or haven't been as much impacted by higher interest rates. So this is ABS data. No doubt Westpac will have a much more granular view on what's happening across the different price segments. So what we're looking at here nationally is the investor trend and the owner-occupier trend broken out by first home buyers versus non-first home buyers. So it's pretty clear when you start to look at these trends, well, first home buyers have been the biggest drop in the value of lending so far. You can see that category or that cohort has dropped in value of lending by about 42% from when lending peaked to that sector, which you can see the peak for first home buyers was a lot earlier. It was back in early 2021, or it could have even been late 2020. So first home buyers are very sensitive to stimulus, to incentives, or to an expiry of those incentives. So as we saw a lot of the fiscal support expiring and housing affordability became much more pressing, then probably not too surprisingly, first home buyer activity has fallen quite sharply. There's also been a real pull forward of demand, which, as we know from previous cycles, like the first home buyers grant boost back in 2009, that similarly resulted in a real pull forward of demand, and now we're on the downside of that. Whereas since interest rates started to rise back in May, you can see investors have been more sensitive to that. And whether or not this is sensitivity to interest rates or is it really sensitivity to falling values is probably something that's a bit harder to answer. But my guess, it's probably more sensitivity to falling housing values. In fact, if we look at the investor trend, it peaked in about March of 22. So it actually peaked before interest rates started to rise, roughly in line with Sydney and Melbourne moving through a cyclical high in values as well. Investors, of course, in Australia generally tend to be much more motivated by prospects for capital gains rather than rental yields. Although rental yields are important, especially when you're demonstrating serviceability for an investment loan, as an example, historically, Aussie investors tend to be much more focused on, am I going to get a capital gain on the property? And of course, when prices are falling, that really disincentivizes investors. But my guess is when we see housing prices stabilize along with the ceiling in interest rates, that's when we'll start to see investors becoming a lot more active, taking advantage of pretty good buying conditions, the drop in prices, the tight rental markets, the rising yields as well. But a sector that's been more resilient, of course, is your owner-occupiers who are subsequent buyers. They tend to have more equity, less sensitive to interest rates, and they generally have a legitimate reason for buying or selling. You know, they might be upgrading or downsizing or moving, changing jobs, that sort of thing. We've also, of course, seen a bit of a tightening in lending policies. No doubt at Westpac, you guys are seeing this, a little bit more risk aversion, especially around high DTI lending or high LVR lending. The encouraging or the positive thing here is this isn't coming about through any sort of overt policy mechanisms that APRA have implemented. You know, I don't see the inner workings or even the external workings of APRA, but chances are they are working pretty closely with lenders over the desk, so to speak, particularly around high DTI and high LVR lending, which you can see is trending lower as a proportion of originations. Another risk factor, of course, simply comes back to the sensitivity of households to higher debt levels. And I really like this graph because it sums up that sensitivity equation. So to read the graph, by the way, you've got the red trend line here is the household income to debt ratio nationally, and the blue trend line is the housing debt to income ratio. You can see that housing is the vast majority of household debt, around 70% of it. But the interesting thing is household debt is at, well, at least at this is up to June of this year. It was at record highs at that stage, nearly 190% of annual disposable income, which means that households are much more sensitive to rises in the cost of debt. So the last time interest rates got to this high, household debt levels were about 17% lower than they are now. And the last time interest rates were rising this quickly, which was back in 1994, you can see that household debt levels were about a third of what they are now. So it just highlights that you know, borrowers are going to be much more sensitive to higher interest rates, especially at a time when non-discretionary inflation is as high as what it is. No doubt there's a pullback in consumption around the corner as households and borrowers focus on their debt obligations, which is normal in Australia. We have typically historically very low arrears rates, which will probably rise a little from their record lows, but also households focus on funding their cost of living, fuel, housing, utilities, energy costs, all that sort of stuff. Pretty hard to pull back your spending on. So it probably means that households will finally start to respond to this changed environment and pull back on their consumption. I think we started to see that already in the retail spending figures, at least on the volume data rather than the value data. What's helping to keep a bit of a safety net under the market, of course, is the fact that labour markets are extraordinarily tight. In fact, if anybody tuned into the labour force reading that came out, I think it was late last week, we saw the unemployment rate drop to 3.4% from 3.5%. So we're pretty much at generational lows. Haven't seen unemployment levels like this since the 1970s. Underemployment very low as well. Chances are labour markets are going to loosen up. I think pretty much every forecast I'm looking at has unemployment up around the mid-4s by 2024, early to mid-4s. But of course, that's still about a full percentage point below the 10-year average. So as long as mortgage holders or borrowers have a job, we generally expect distress to be contained. Don't expect arrears rates will remain at their current record lows, that they will rise, but getting above, say, 1% of the 90-day arrears rate, I wouldn't say that's a certainty, but definitely not getting far above that is probably much more unlikely. We know that households are in a pretty good position as well, in part related to this history of savings that went on through COVID and an accumulation of prepayments on their mortgages, especially variable rate borrowers, of course. So this is another factor that should help to protect or insulate the housing market, especially as we start to move towards what's going to be a period of a lot of refi activity. What people describe as the refi cliff, or this period coming into about April of next year, when there's going to be a lot of these fixed rate loans that were secured through 2020 up to around late 2021. They're coming up for expiry around early to mid 2023. So a lot of these borrowers who you can see the graphs on the right, by the way, are from the RBA, and the graph on the bottom right, you can see most of this fixed rate lending was on 2-year or less terms, which means, of course, we're going to be starting to see a lot of this activity flowing through next year as these fixed rate borrowers move from a fixed rate of about 2% up to something that's probably going to be closer to maybe 5.5% as they refi onto a variable rate. With some of these people looking to maybe refi externally, but you'd have to argue that as competitive as it's going to be, there are going to be a lot of borrowers who probably can't refi externally because the value of their home has fallen. So that'll be an interesting one to watch, but clearly this is a downside risk for the housing market, and how borrowers navigate this refi cliff will be really important to watch quite closely. No doubt the banks are already starting to communicate with anybody who will be experiencing a refi event, making sure they're prepared for it, that they're budgeting for it. I think just making sure that there's as much communication going on as possible will help to minimize the shock, at least, of any change. So as I mentioned in the intro, rental markets are extraordinarily strong as well. So we're seeing rents nationally rising at about 10%, a little bit less for houses, a little bit more for units. And the transition in rental growth towards units has been really interesting to watch. So you can see the trend earlier in COVID, where this red trend line, which measures the rolling annual change in unit rents, went through this period of quite extraordinary weakness. That was in response to overseas migration. Pretty much, the switch got turned off, and we saw a lot of domestic preferences for rental demand moving towards areas with more space. Houses rather than units, outer fringe rather than inner city, regional rather than the metro, that type of thing. But very quickly, as we started to see rental affordability becoming more challenging, and as more workers returned to work and inner cities became vibrant, and now that net overseas migration is rebounding so quickly, we are seeing medium to high density rental sectors absolutely powering ahead, whereas rental growth for houses is starting to ease a little bit. Not fall or not stabilize, just starting to see the rate of growth coming down. And I think this partly at least reflects affordability pressures in the rental market as well. Remember, renters tend to have much less elasticity than home buyers. They can't go out and get credit to pay the rent, can't get a loan to pay your landlord. So arguably with inflation as high as what it is, even though incomes are rising, wages growth is still negative in real terms, you'd have to think that a lot of renters are going to be either looking for cheaper options like moving to an apartment over a house, but also probably thinking about restructuring. If I could just flick forward a couple of slides, that restructuring of households was very evident through the pandemic, where we saw households becoming smaller, particularly rental households. For example, group households splitting to become couples or single persons, or minimizing their tenancy by utilizing, say, the second bedroom as a home office. Now we're probably starting to see a reversal of that. Even though the graph on the bottom left, which the RBA estimates that average household sizes are still diminishing, I'd have to say there's going to be a reversal in that trend as rental households in particular become larger, maximising their tenancies in order to spread their rental costs across a larger base makes a lot of sense to me when rental affordability is going to become more and more challenging. You can see that rental supply is still extraordinarily low, and there's no real supply improvement happening at the moment. This is just tracking rental listings. You can see rental listings, total listings, the graph on the right is more than a third below the 5-year average, and still, you know, maybe stabilizing if you really use your imagination there, but probably still trending lower. And if you look at vacancy rates, I'm sorry for flicking around a little bit. Where's my vacancy rate graph? I think it's the next one. Here we go. So vacancy rates holding around 1%. I'd be surprised if vacancy rates moved materially lower than this. It's kind of like unemployment will never get down to zero. There's always going to be some churn. Same in rental markets. But you can see some markets like Adelaide has got a vacancy rate of 0.3%. Perth's at 0.5%. Vacancy rates are going to remain low, mostly because of what we're seeing in overseas migration rebounding back so solidly. In fact, through the March quarter, back to record levels. A lot of catch-up playing out here, a lot of pent-up demand of people wanting to return back to Australia. So that will normalise, but absolutely, we're definitely seeing this overseas migration feeding directly and immediately into rental demand rather than purchasing demand. Gradually, that'll flow into purchasing demand, but the most immediate impact here is flowing into rental markets. So some of the good news here, if you're a renter, obviously this is pretty confronting. I wouldn't expect rental prices to start coming down anytime soon. But for investors, for landlords, you can expect your yield will be improving. Okay, simply because housing values are falling at a time when rents are rising quite rapidly, which means your gross yield profile is starting to trend higher, which you can see here. Still below average levels across most markets, but I don't think it'll take long to get back to yields, especially around markets like Melbourne and Sydney, where rents are rising quite quickly, especially in the unit market. We'll see rental yields getting back to about the decade average, I think, within the next 6 months, if not sooner than that. The construction side of things, we're going through this really interesting phase now where the pull forward from home builder has now seen house approvals return back to about average levels. But look at the unit trend. There simply hasn't been a supply response across the unit market. Home builder was very much skewed towards houses rather than units, just because of the eligibility criteria. We had to start building within 3 months of signing the contract and getting the grant. Units, very, very hard to do that. You had to already be in the sweet spot where you're ready to start building in order to do that. As well as the fact that units, remember, units have about a 2-year sort of time frame to go through an approval and then get out to completion, maybe even longer than that, considering what's happening in some of the supply chain constraints and labour market constraints for residential construction. Arguably, the unit market is heading for an undersupply. Maybe it's already there. But we do know that construction costs aren't slowing just yet. Our September quarter Cordell Construction Cost Index, the CCCI, it accelerated through the September quarter. But the interesting thing here is, even though we're seeing construction costs rising at the fastest pace on record, well, at least outside of the introduction of the GST, what's driving these costs is changing. Early in the pandemic, it was about external factors, or factors external to Australia, supply chain bottlenecks, price rises coming out of Europe and so forth. There was that ship that got stuck in the Suez Canal, and a huge buildup of cargo vessels in Shanghai and so forth. Now what we're finding is really driving construction costs tends to be more about labour costs, fuel costs locally, transport costs, waste disposal fees, professional fees, as well as still materials like timbers, especially structural timbers, metal products still very high in price as well. Hopefully we start to see a resolution here, but with such tight supply and supply chain bottlenecks, it is taking a lot longer to get through this construction cycle than what you would normally see. So wrapping up, looking forward, I want to make sure we have a good sort of 10 minutes or so to go through the Q&A. But don't forget to put your Q&A in the chat box, guys. Just to wrap things up. So clearly the market is still very exposed to downside risk. what we describe as the headwinds here. You've got interest rates, which I think are going to be the primary factor that's driving the trajectory of housing markets. I think once we see rates find a ceiling, we'll probably find housing prices find a floor as well, or maybe soon after that. We know that inflation is amplifying the higher cost of debt as well, especially across a household sector that's highly indebted. We know that there's a refi cliff ahead of us that's going to be seeing a large portion of loans refinancing from a very low interest rate, about 2%, up to something that's probably going to be closer to around the mid-5s. I think the RBA recently estimated that about 30% of loans across the lending portfolio were on fixed rates. Normally that would be about a fifth. And normally you'd see around 15% of originations moving onto a fixed rate. At the moment, it's about 4%, but through the peak of the pandemic lending cycle, it was about 46%. So you can see what I mean by that bulge in refi is just around the corner, which will be one that will be a bit challenging to navigate. We know that housing affordability is becoming more challenging, but that discussion's pivoting more towards serviceability. As prices fall, it's a bit easy to get your foot in the door to raise a deposit, although arguably that's also being eroded by high inflation. But once you sort of get your foot in the door, now it's more around demonstrating your ability to service a loan under higher interest rates. It's going to be more challenging. Borrowing capacity has dropped quite substantially. We know there's more supply coming into the market from newly built homes, although I don't think that's going to be a big risk because it's all mostly owner-occupiers who have pre-committed to that. And we know that sentiment really drives or correlates highly with transactional activity. We may start to see a bit of a bounce back in sentiments in line with the really tight labour markets, but let's see what happens there. But on the tailwinds, the factors that should help to keep a floor under housing prices and demand, well, labour markets I talked about quite a bit. The household sector itself is looking quite in a very good position. We know Australia economically is very well positioned to navigate this what's likely to be a global downturn, a global recession in economic activity. Again, I'd encourage you to consult with your own economics team, but it looks like the consensus view is Australia probably will avoid a recession. And of course, migration and open borders are stimulatory in themselves. So what can we expect going forward? Well, rather than trying to take you through the forecasts, which I know Matthew Hassan and his team have recently updated you with, let's look at some scenarios. So remember, the mainstream forecast is generally for about a 15% drop in housing values at a fairly macro level, larger drops in Sydney and Melbourne, generally smaller drops in the other markets. But let's have a look at what would we need to see happen before housing values got back to their pre-COVID levels. Well, I think I started with a comment around Melbourne. It looks pretty certain that Melbourne probably will reduce to pre-COVID levels. We only need to see housing values there fall by another 3.5% before they're back to the same level as March 2020. Remember, Sydney housing values are already down a little bit more than 11%, based on a daily index from March 11th, which was when COVID was declared a pandemic, through to pretty much yesterday. Our daily index is showing about 11 point something drop in Sydney. But we need to see housing values fall by another nearly 11% before they go back to March 2020 levels. Every other region around the country has a significant value buffer before we get back to those pre-COVID levels, which I think is looking highly unlikely. Another way to look at these sort of scenarios is just to look at, say, Westpac forecasts, and say, for example, if it was an expectation for a 15% drop, well, that takes our national index back to where it was in April of 2021. The vast majority of homes in Australia are still going to be worth more than what their owners paid for them, let alone their level of equity that they hold in the property. A 20% drop takes our index back to roughly January 21, but also pretty similar to where it was back in late 2017. But of course, these scenarios are very different from city to city. So, for example, a 15% drop in Melbourne from its peak would take our index back to early 2017 levels. wiping out a little bit more than 5 years of capital gain in the market. So arguably this becomes a little bit more risky when you look at some of these sort of scenarios. Again, most homeowners who've owned their property for that period of time, they would have been paying down their principal. They already had probably a 15-20% deposit as well. So the risk arguably is much more skewed towards recent buyers who maybe didn't have a large deposit and may be more exposed to declines in some of these areas. So on that note, I'll wrap it up there. I've got Fraser's details here. He's your go-to person at Westpac as well. Feel free to ping me as well. I've got my email address there, and I might pass it back to Costa, and we can cover off on any Q&A that might be coming through. Costa.
Absolutely, Tim. Thank you, as always. Very informative. We have quite a few questions here. I'll try and get through them. Karen just asks, do you see any similarities with Keating's recession we had to have of the 90s attributed to inflationary pressures and build-up of government debt at that time?
Yeah, I mean, absolutely, there are some similarities, but there's also some significant difference as well. So we are seeing housing values falling faster now than they did back in the early 1990s. Remember back then, household debt levels were a lot lower as well, about a third of what they are now. So the household sector arguably is much more sensitive to higher interest rates. But of course, back then, interest rates were coming out of, mortgage rates at least up around 18% for a very brief period of time. So mortgage rates were very different, but of course, household debt levels were much lower, and that's probably the biggest difference. Maybe one of the similarities comes simply back to the fact that that recession was pretty short and sharp. It certainly wasn't a prolonged one, and generally following a period like that, we see some stimulus being pumped into the economy. I'm not sure how much fiscal support would be plowed back into the economy after such a long period through COVID, where after a period through COVID where fiscal support was unprecedentedly high. I don't think the government would have the same appetite to really fuel the economy on the back of more spending, especially with inflation doing what it's doing. So I think once we get through a peak in interest rates and housing prices will probably stabilize from there, the next question is going to be, of course, when do interest rates start coming down? Arguably, that's probably going to be some time, maybe late 23, maybe 2024, although I'm sure Bill Evans and co will have their house view on when that's going to be.
Yeah, fair call, fair call. We've actually got Bill here at 150 Collins next Thursday. Nice segue there, Tim. So for those on the call, feel free to reach out. I'll certainly get an invite forward. Tracy just asks, do you think with all the flooding it'll affect the market now? I think you sort of covered that off in there though, Tim.
Yeah, well, I don't think it's going to have a material effect at a macro level. It's going to be quite focused on the areas that have been flood impacted. So what I mean by that, if you go to, just choosing a market like Orange, for example, or Forbes, for example, areas that have been heavily impacted, what we normally see through, say, previous flooding events or bushfires or cyclonic activity, that type of thing, is a couple of phases following that. Obviously, once the floodwaters subside, then that's where there's a massive rebuild effort that goes on. And that could be partly stimulatory, getting more people into an economy, spending a lot of money to rebuild. So that in itself can be stimulatory, but you'd have to imagine for housing prices, there's going to be a period of inactivity. And then trying to read through the noise of, well, because when we build our price indices, of course, it's one of the key inputs is recent sales, and trying to understand the impact on recent sales. Is it a flood impacted property that hasn't been fixed or repaired, or is it something that's been renovated and rebuilt and now it has a new market value? It's very hard to actually measure the impact without going into a huge amount of effort on individual properties to understand what's happening. So I think following this period, you will see a period of volatility. Well, first of all, a period of inactivity and then a period of volatility before we really know how housing prices responded. But more broadly, we're already seeing extreme supply chain constraints for residential building materials. And of course, with another rebuild effort competing with an already historically high level of residential construction activity, as well as a huge amount of big infrastructure projects underway, they're all competing for similar skill sets and similar materials. So arguably, it just makes that supply scarcity all the worse as we move into a rebuild effort.
Valid. Try getting a tradie around these days, Tim. Oh my goodness, it's challenging to say the least.
Yeah.
Property purchasing decisions being influenced by changeover costs, especially selling agents' commissions, purchasing costs, etc. Transfer costs. I'm not sure where the.
I kind of don't know what the question might be. So, generally there is expectation as the market slows down and housing becomes much more competitive from a real estate agency perspective. Perhaps there could be some pressures for real estate agents to rein in their commission levels in order to get the listing. To be honest, I don't really see much evidence of that. And commission rates vary pretty markedly from state to state. In New South Wales, for example, or Sydney Metro, for example, typical commission rates are generally about 2%, maybe even a little bit less than that. Go to Queensland or Southeast Queensland, they're generally about 2.5%. So there's quite a bit of variability, but it's pretty rare these days to see a holistic pullback in commission rates. I think real estate agents are going to be doing it tough, right? We've seen a fall in volume, listing numbers remain very low. So I think even in that sense, they might be more reluctant to drop their commission rates. But of course, commission rates aren't set in stone. Anybody looking to sell their property, they can generally negotiate with their agent. But I'd argue the best agents are going to be pretty firm on their commission rates, and you pay for their expertise. So just be a little bit wary of agents with a low commission rate. Maybe they're not going to get you the best price.
Sure. No, good advice. Any ideas when will be a good time to sell a house again?
Yeah, I'd say at the moment is clearly pretty tough selling conditions. I think a better time to sell is probably going to be coming into a period where we start to see demand rising. When that is highly uncertain, right? So some of the signposts you're going to be looking for is, like I said a couple of times, look for improvements in sentiment. Housing volume and sentiment tend to move hand in hand. Look for a stabilization in interest rates, which provides some certainty as well. That's probably when you'll start to see at least a stabilization in selling conditions. The best selling conditions tend to be through the growth cycles, of course, where we're seeing buyer competition is quite frenzied. FOMO comes back. That's still going to be a long way off. So I think if you're looking to sell your home, trying to time it is going to be quite hard. Arguably, getting into the market now before prices fall further is what some people are choosing to do, whereas most other prospective vendors look like they're simply holding off at the moment, waiting for some certainty to return. So arguably, I think just trying to answer your questions concisely, coming into say mid to late next year, you'd have to think the market will have stabilized by then, maybe starting to see some more activity returning. But as soon as we start to see interest rates coming down, you'd have to expect that buyer demand will start to pick up.
Sure. Thank you. The next one, can you please advise whether the current market is for buyers or for sellers?
Yeah, it's absolutely a buyer's market. I know there's going to be some variability. Some of the graphs I showed a bit earlier on, maybe just flick back to them really quickly, was average selling time and the rate of vendor discounting. These graphs here and clearance rates. So normally when you start to see selling time rising, discounting rates coming down, clearance rates at below average levels, it speaks to me that says, yeah, this is a buyer's market. Buyers don't have the same level of urgency they were facing back when the market was really hot. So back here, say in late 2020, sort of through to mid 21, homes were taking like 19 days to sell. That was absolutely a seller's market. But now, even though there isn't a great deal of stock to choose from, buyers can generally take their time, they can negotiate. If they don't get the price they think reflects true market value or their budget, they can move on to the next property. a year ago, if you tried to negotiate too hard, someone just came in and bought the home out from under you. So absolutely, it's a buyer's market now. Although you've just got to be a little bit wary of the fear of paying too much has replaced the fear of missing out. So you just need to be a little bit cautious around buying into a market where prices are falling. You could find the value of your property is less than what you paid for it. So trying to time that is virtually impossible. But as long as you negotiate hard and make sure you're fairly conscious of what a true market value might be, then generally it's a pretty good time to buy.
Nice. So the prediction for rates to decrease would be fixed rate before variable?
Yeah, that's typically how it would work. In fact, it does look like we've already seen a couple of lenders have reduced their fixed rates, or at the very least starting to see fixed rates stabilizing as well. So maybe that's a sign that we are approaching a peak in a rate hiking cycle. But again, your own economics team is probably a much better source of that. And keeping in mind Westpac's view on the cash rate up at 3.85% peak, financial markets are still forecasting or pricing in a peak in the cash rate at similar levels, sort of high threes, although that's down from low fours where it was a couple of weeks ago. So yeah, you'd have to expect fixed rates will probably move before variable rates, but there's a pretty big difference between the two at the moment, which is probably why we're only seeing about 4% of borrowers taking on a fixed loan at the moment.
Sure. Hi, this is from Josh, one of my colleagues. Hi, Tim, great presentation. For those investors sitting on the sidelines, when do you anticipate this fall will bottom out?
Hey, Josh. Yeah, I think investors will start to become more active once interest rates find a ceiling and prices stabilize. Remember, investors are generally mostly motivated by capital gains. They're probably fearful of buying an investment property that are going down in value. But I think as soon as we start to see signs that things are stabilizing, that's where we'll see investors becoming much more active, positioning for medium to long-term capital gains, but also taking advantage of the price drops and the fact that rental markets are as tight as what they are. So at the moment, you've got a rental market that's extraordinarily tight. Generally, when we look for rental supply or signs of more rental supply coming in, we look towards the private sector. That's where a little bit more than 80% of rental properties are owned by mum and dad investors, so to speak. But we're not seeing any sort of supply coming in from investment. In fact, investment's falling pretty sharply. So yeah, to answer the question, I think it'll probably be once interest rates stabilize. So hopefully that's around the first half of next year.
Perfect. Jeff says, anything government is going to do to keep the house of value or just let it drop?
Yeah, interesting question. I mean, there's already a few things the government's doing to not necessarily support housing prices, but maybe just try to combat affordability pressures to some extent. So, there's the home buyer guarantees, there's stamp duty changes we're seeing in New South Wales at a state level as well. There's still the first home buyers grants that are available. There's a lot more funding coming in from 2024 for social and community housing as well, which is more from a build to rent perspective. But I don't think you'll see a lot of fiscal support coming in from the government aimed at supporting housing prices. I think this time around it'll be much more a monetary policy response of stabilized interest rates, and then maybe gradually or eventually falling interest rates that probably help to keep a floor under housing prices, rather than any real concerted efforts to pump up, say, demand. Normally what we see from a policy perspective would be incentives aimed at first home buyers. I think everyone acknowledges that generally just stokes demand, pushes prices higher, gives first home buyers a bit of a leg up temporarily, but does nothing to address the underlying affordability issues in the market. So yeah, I don't think the government's there just to let prices fall, so to speak, but in the same sense, I can't see policy responding to boost prices or protect prices at all either.
No, fair. And this is from Ali, should we go for fixed or variable home loans from mid-2023 onwards?
I don't know.
We've
Is my
got to get your
question.
crystal ball out.
I'm a disclaimer on that one, I think. Personally, not financial advice, but generally, you find most Australians opt for floating rates, for variable rates. It's more than 80% typically that would be choosing to go variable. But I'd be looking at if you're coming to a period where you need a refi or you're getting a mortgage, just look what fixed rates are doing. If they've come down by then, then maybe that would be a good option. We're seeing a lot more people as well splitting their home loan to kind of cover both bases, putting some into a fixed rate loan and the balance into a variable rate loan, taking advantage of things like offset accounts and so forth in your variable. So yeah, I definitely encourage you to speak to your banker or a broker before making those sort of decisions. But everyone's going to have their own circumstances. But it really depends on what happens around the middle of next year and if fixed rates are coming down or not.
Yep, sure. And as you said, I mean, in the new year, we've got a heck of a lot of fixed rates rolling off, which sort of lends into this next question. And I'd say to everyone still on the call, don't hesitate if you wish to speak to any of our team. Now's probably in a really appropriate time, even if it's just comparing the rate that you're currently receiving from your own bank, or if you're with Westpac already, reviewing those rates accordingly. When will be the significant part of the fixed loans expiry? I think you sort of covered that in the sort of March, April next year. We're expecting a fair roll.
I'll bring up that slide again because these are the two graphs on the right-hand side here from the RBA. The top right-hand side graph just highlights when that bulge starts working its way through, pretty much from April through to the early part of 2024 is when you'll see the bulk of those loans expiring.
Sure. And a bit of crystal ball gazing again. Is it a good idea, this is from David, to buy an investment property now since the prices are falling?
Sorry, Costa, it just broke up then, mate. Can you just ask that one again?
Apologies. Is it a good idea to buy an investment property now since the prices are falling?
Well, it's a good time to start considering it. There's no urgency, that's for sure. Like I said before, I think a lot of investors are really just trying to time the market. That's notoriously difficult. Easy in retrospect, you can look back and say, okay, that was the bottom of the market. But it's very hard to do in practicality. So if I was looking to invest at the moment, I'd definitely be getting the groundwork out of the way, deciding where I wanted to invest, what sort of style of product, what my budget was, maybe working with your bank already to sort of figure out how much you can lend, and then getting ready to push the button. Just keep in mind, there's no real urgency. You got time on your hands, and the market's probably not going to find a floor until interest rates find a ceiling. So yeah, a bit of time there. But remember what Warren Buffett says is be greedy when others are fearful. So in that sense, then it's probably good to swim against the current to some extent, but you don't want to buy too early in this down cycle because then you'll have, the first part of the upswing is going to be a little bit wasted in the sense of rebuilding your wealth from where prices fell. So yeah, I think a lot of people are going to wait until there's more evidence that the market's closer to bottoming out.
The T-bone man, Warren Buffett, well said. Dollar cost averaging into the S&P as well, isn't it? Now, we've got one from Tracy here with a question in relation to New South Wales wanting to charge stamp duty as an annual fee. What are your thoughts on this? I feel it would be double dipping.
Yeah, it's not, I wouldn't agree. I don't think it's double dipping, but this is positioned as stamp duty reform, but it's really stamp duty reform in sheep's clothing, if you will. So what I mean by that is it's more of a first home buyer incentive than it is any sort of stamp duty reform. So I think a lot of first home buyers will take advantage of this policy. One of the biggest barriers to getting into the market is funding your transactional costs, and particularly in New South Wales, you're talking, quite often upwards of $30,000 or $40,000 just in your stamp duty payment. So I think with that in mind, a lot of first home buyers will probably opt for the land tax component rather than stamp duty. And the other, I guess, compelling reason I'm saying that is remember when the New South Wales government first announced this, and the initial sort of policy was if you took advantage of the land tax option, you lock that property into paying land tax in perpetuity. Whereas they revised that on the new launch, and for a first home buyer who takes the land tax option, when they go to resell it, they can then, whoever buys it has the option once again, or if they're a first home buyer, they have the option once again. So yeah, anyway, I don't think it's a remarkably smart policy in terms of stamp duty reform, but it probably will attract more first home buyers into the market who end up paying that $400 a year plus the 0.3% of their underlying land value.
Tacked onto that question just by Tracy, and I think we've just covered a bit of it, but they're saying it's mainly for first homeowners, which I don't understand. This is, I suppose, yeah, I should have realised it's tacked onto the stamp duty question. It's for first home owners, which I really don't understand. When we already have a first homeowners grant available, I feel it will bump prices up again. Yeah, that is the stamp duty part.
That's exactly right. So if I can give my own team a bit of a plug, Eliza Owen, who heads up our Australian research, she put a blog out on this I think it was either today or yesterday. Have a good read of it. So it's pretty much essentially what I was talking about, that this isn't really stamp duty reform. It's a first home buyer incentive. It does nothing to address the inefficiencies of stamp duty, which are a major disincentive for, say, downsizers to free up more established housing and utilize all those bedrooms for, say, a young family. So it doesn't really reform the key issue of stamp duty, which is just it's a massive inefficiency and a blocker for transactional activity that just simply shouldn't be there.
Yep, fair. Thank you, Tim. And looks like we've just got one in from Fred. What's the likelihood capital gain tax discount and negative gearing changed by the government in the near future for investment properties?
I can only speculate, and it looks like the Labor Party, who, remember back in 2019, one of the reasons they probably lost the election was because they did have a platform of taxation reform exactly along those lines about, you know, reining in negative gearing and capital gains tax concessions. I'd be surprised if they toyed with that again. You know, sure that they might have a bigger margin where they can actually roll it through, but yeah, I think they might have learnt their lesson. And to be honest, I think at the moment we should really be encouraging or incentivizing private sector investment because we desperately need more rental supply. At the moment, I think private sector investors are feeling like there's just obstacle after obstacle being put in front of them. Be it, you know, back in 2017, the government removed the ability to depreciate items that you haven't bought yourself. We've seen higher tax rates for investors, higher stamp duties, higher municipal rates as well. So there's a whole long list of disincentives for investors there, and I'd be kind of surprised if the government went down that path of once again trying to contemplate changes to negative gearing or capital gains tax concessions.
Perfect, perfect. Well, you're probably not wrong there. The object of once you win power is to retain it, isn't it? So yeah, why would you tweak with something that's so near and dear to our hearts? Which sort of brings us to the conclusion there, Tim. I think we've covered all of our questions. Thank you so much. As I said, near and dear to our hearts, property, you know, it's super popular, and you've really hit the high notes for us there today. So thank you. For everyone on the call, I did put in the chat bar, slides will be provided to everyone that registered. So look out for those. You'll have some contact details for Tim and his team, as well as myself. So if you do need any follow-up at all, don't hesitate, just reach out to us directly or via email. We've got some fantastic offers over at the bank side of affairs. So as I said earlier, if you're thinking about refinancing, if you're thinking about just comparing rates, don't hesitate. Now's probably the time to at least contemplate, you know, putting your house in order. On behalf of the corporate partner team, again, thank you, Tim. everyone on the call, have a really good Christmas and New Year. We'll be back in February with more of our national webinars. We try to run one per month. We'll certainly be looking to close out the year again with the enigmatic Tim Lawless giving us all an overview of the property market. So yeah, thank you, Tim. Thank you, everyone on the call.
Many thanks, Costa. Thanks, everyone.